Hi guys, welcome to this channel. In today's episode, we're going to focus on Bitcoin halving and its effects. So fasten your seatbelt and please hit the like button below this video. One of the most pivotal events on Bitcoin blockchain is halving. It induces inflation in cryptocurrency's price by reducing the number of Bitcoin in circulation and increasing demand for Bitcoin. To explain what a Bitcoin halving is, we must first understand a bit about how the Bitcoin blockchain operates. Bitcoin's technology, blockchain, basically consists of a collection of computers that run Bitcoin software and contain a partial or complete history of transactions occurring on its network. Each full node or a node containing the entire history of transactions on Bitcoin is responsible for approving or rejecting a transaction in Bitcoin's network. To do that, the node conducts a series of checks to ensure that the transaction is valid. These include ensuring that the transactions contain the correct validation parameters and does not exceed the required length. Each transaction is approved individually. It is said to occur only after all the transactions contained in a block are approved. After approval, the transaction is appended to the existing blockchain and broadcast to other nodes. So now that we know what a Bitcoin blockchain is, let's talk about Bitcoin halving now, the main purpose of this video. Bitcoin halving. After every 210,000 blocks mined, or roughly every 4 years, the block reward given to Bitcoin miners for processing transactions is cut in half. This event is referred to as halving because it cuts in half the rate at which new Bitcoins are released in circulation. This is Bitcoin's way of enforcing synthetic price inflation until all Bitcoins are released. At that point, miners will be rewarded with fees which network users will pay for processing transactions. These fees ensure that miners still have the incentive to mine and keep the network going. Before I go further on this video, I want to quickly state that we are not financial advisors. This video is for entertainment purposes only. The halving event is significant because it marks another drop in the rate of new Bitcoins being produced as it approaches its finished supply. The total maximum supply of Bitcoins is around 21 million. As of October 2021, there are about 18.85 million Bitcoins already in circulation, leaving just around 2.15 million left to be released via mining rewards. In 2009, the reward for each block in the chain mined was 50 Bitcoins. After the first halving, it was 25, and then 12.5, and then it became 6.25 Bitcoin per block as of May 11, 2020. To put this in another context, imagine if the amount of gold mined out of the earth was cut in half every 4 years. If gold value is based on its scarcity, then a halving of gold output every 4 years would theoretically drive its price higher. So now that we've discussed Bitcoin halving, let us talk about the implication of halving. Halvings reduce the rate at which new coins are created and thus lower the available amount of new supply even as demand increases. This has some implications for investors as other assets with a low or finished supply like gold can have high demand and push prices higher. In the past, these Bitcoin halvings have correlated with massive surges in Bitcoin price. The first halving, which occurred on November 28, 2012, saw an increase from $12 to $1,217 on November 28, 2013. The second Bitcoin halving occurred on July 9, 2016. The price at that halving was $607, and then by December 17, 2017, a Bitcoin's price has soared to $19,800. The price then fell over the course of a year from this peak down to $3,276 on December 17, 2018. The most recent halving occurred on May 11, 2020. On that date, a Bitcoin's price was $8,787. On April 14, 2021, a Bitcoin's price soared to $64,507. A month later, on May 11, 2021, a Bitcoin's price was $54,276, representing a 517% increase that seemed more consistent with the behavior of a 2016 halving. So now, let's talk about the effects of halving. In the event that a halving does not increase demand and price, then miners would have no incentive. The reward for completing transactions would be smaller, and the value of Bitcoin would not be high enough. To prevent this, Bitcoin has a process to change the difficulty it takes to get mining rewards, or, in other words, the difficulty of mining a transaction. In the event that the reward has been halved and the value of Bitcoin has not increased, the difficulty of mining would be reduced to keep miners incentivized. This means that the quantity of Bitcoins released as a reward is still smaller, but the difficulty of processing a transaction is reduced. This process has proved successful twice. So far, the result of these halvings has been a ballooning in price followed by a large drop. The crashes that have followed these gains, however, have still maintained prices higher than before this halving event. For example, as mentioned above, the 2017 to 2018 bubble saw the value of a Bitcoin rise to around $20,000, only to fall to around $3,200. This is a massive drop, but the Bitcoin's price before the halving was around $650. Although the system has worked so far, the halving is typically surrounded by immense speculation, hype, and volatility, and how the market will react to this event in the future is unpredictable. The third halving occurred not only during a global pandemic, but also in an environment of heightening regulatory speculations, increased institutional interest in digital assets, and celebrity hype. Given these additional factors, where Bitcoin's price will automatically settle in the aftermath remains unclear. How does Bitcoin halving affect Bitcoin's network? Since Bitcoin halving is a major event, it has a major effect on various parties involved in Bitcoin's network. Here is a brief description of how Bitcoin halving affects major stakeholders and talking points in Bitcoin's network. For investors, halving generally results in increased price for the cryptocurrency due to reduced supply and surging demand, meaning it is good news for investors. Trading activities on cryptocurrency blockchain increases in anticipation of the halving. However, the pace of price increases differs based on the logistics and condition of each price halving, as demonstrated earlier. For miners, the effect of mining on Bitcoin's ecosystem is complicated. On the one hand, a diminishing Bitcoin supply increases demand and price, but fewer rewards can also make it difficult for individual miners or small mining outfits to survive in Bitcoin's ecosystem, because they may find it difficult to compete with large mining organizations. According to research, Bitcoin's mining capacity is counter-cyclical to its price. Thus, when the cryptocurrency's price increases, the number of miners in its ecosystem decreases and vice versa. A halving event is characterized by a price increase and can increase the probability of a 51% attack on Bitcoin's network because miners move out of its network, thereby making it less secure. So in today's video, we've talked about Bitcoin halving and the effect it would cause on both investors and miners. We've talked about histories of Bitcoin halvings, the implications, and that will be all for today's video, guys. If you want other videos like this, please make sure to hit the subscribe button below. Please like and share this video. That will be all for today, guys. Thank you so much.